Hi, and a very good evening, everyone. It has been a fairly intense day, and we're finally down to the last session. So I would also like to shout out to our virtual guests and attendees. Hi, you're not forgotten. And in terms of context, what we'll be covering for this session, we'll be looking at DC asset risk. We'll be kind of trying to pick up where the earlier session left off. We'll be zooming into some of the inherent complexities that are there. And we'll also dwell a little bit into how can we kind of broaden the funding channels available for the data centers in Malaysia today. So it's currently predominantly dominated by loans as well as PE to an extent. So what naturally will get a rating agency excited is if we have more data centers to rate and if we can bring them into the bond market. Okay, with that, we'll start with a short poll from the audience. If you all don't mind scanning your pigeonhole. Give us a minute. Okay, this is a very interesting observation. I think the votes are still coming in. Okay, it's in favor of, I think, clear favorite, economics and bankability, which will be quite nicely covered later. This is not a trick question in terms of understanding the audience, but naturally all these parameters and conditions that we have listed here are building blocks to funding any infrastructure projects. So naturally, this will also apply to data centers. So with that, we will start our conversation, keeping this in mind. I would just like to have a short public service announcement that Roy may have to leave midway because he has a flight to catch. So he's not running away from the questions. Okay? All right. And we'll open our session today. Welcome to our panelists. We have a nice combo here. We have a lawyer, we have a banker, and we have a credit rating agency rep. Okay? So we'll start off with Kelvin. Kelvin, could you please walk us through the establishment of a data center from a legal and regulatory perspective? I think it's a given that Malaysia has showcased their ability in terms of drawing data center investments from both local and global entities. Please feel free to cover some of the risk areas such as foreign equity restrictions, land ownership, approvals, central bank requirements, and as such. Over to you.
Hi, good afternoon. Nice to be here. Thank you to Ram for inviting us. And I think I'm the only lawyer in the room. Not sure. So I think I won't do justice if I don't explain a bit about the legal side of investing in data centers. Very quickly, I will just touch on three main areas, which will be pertinent for especially foreign data center operators investing into Malaysia. And some of the points are also relevant for financing, which I'll touch on later. So the first area is land related, relating to acquisition of land. The second is relating to the Communications and Multimedia Act, the licenses related to that. And the third one relates to Bank Negara approval, where you want to raise offshore financing. Okay, so on the land bit, when a DC operator wants to acquire land, first thing is that the title itself. So normally it is either a building title or industrial, right? Actually, the correct designation is building, but for certain areas, it's such that the land office has designated that area as industrial. And typically what we see is that there has to be an express condition stated on the title to say for data center use. because there used to be some confusion as to which was the right category of land use for data center operators. And related to that is sometimes when acquirers purchase land, the land is still under agriculture, so it has to be converted. And I'm mentioning this because it does affect the timeline for completion, and ultimately it affects funding. Because the longer the deal completes, right, there could be issues about what type of security you can take, and also when the money is needed by the purchaser. So you have typically need to provide for maybe 3 to 6 months for conversion of land use. And linked to that is also where under the energy supply agreement with Tenaga, typically Tenaga will require a portion of the land to be surrendered to and then alienated to Tenaga for the substation. Right, so that can be done either as part of the initial conversion process or even later. So I think all this has to be built into the timeline. So you have your surrender plus your conversion. And the next stage is that if the acquirer, if there's any dilution in Bumiputera equity and your deal is more than 20 million ringgit, you need to get the approval of the MOE, Ministry of Economy. This is under the EPU guidelines, right? Now it's under the Equity Development Division of the Ministry of Economy. And even though you don't come within the guidelines, you still need to get a form of confirmation because the land office will need to see that confirmation before you can present your title, right? And that will take about maybe a few months. And after that, if you are a foreigner buying in, you need to get this thing called the 433B approval. I don't know whether you're familiar. Essentially, it's the approval of the state authority where the land is located. So Johor will be the state authority of Johor. And that also takes some time. So end of the day, it could be up to even 9 months to a year before completion. So what we normally see is data center operators asking for early entry to start constructing their data center, because most of the time they would have signed or will be signing the customer agreement with the customer. So these are things to be negotiated between the buyer and seller, and the terms are all, I mean, it depends from case to case. Now, I think one thing to note is that under the MOE approval, there is, if it applies, there is a standard equity condition of 30% Bumiputera equity. I will stop here for this part first, but later on we'll talk a bit about the exemptions that you may get if you are MD status. All right. Moving on quickly to the next two sections on the MCMC bit. So in Malaysia, there is no standard data center law governing data centers as a whole. It is very process driven, very activity driven. So for example, if you just own the core and shell of the building, this is not licensable under the CMA. But if you own the network facilities, if you own the towers, the cables, then there is a license called the Network Facilities Provider License, right? And in addition to that, you provide services, meaning the connectivity, bandwidth type of services to your customer, then that also triggers another license called the NSP, Network Service Provider License. And I think the gist of it is that there are equity conditions under the law, and this is essentially a maximum 49% foreign equity, as well as a minimum 30% Bumi equity. And again, later on, I'll talk a bit about possible exemptions if you are MD status. And the last bit, just to close up, is financing. I think most of the corporates, if you do foreign currency borrowings, offshore borrowings from foreign entities, they're just thinking about Bank Negara approval. So again, there are certain exemptions as an MD status company, which I'll touch on a bit later. But in short, you have the land issues, the Communications and Multimedia Act, the licenses, as well as Bank Negara approvals.
Okay. In terms of navigating the policy and regulatory landscape, I guess we heard earlier that talking about incentives is a bad word, so I won't go there. So maybe you can just walk us through a little bit on what are some of the exemptions or restrictions, workaround that are available for foreign investors or local investors.
Yeah. So I think the core of it, the most important one is the MD status, like MD status from MDEC. Now this used to be called the Multimedia Super Corridor status. If those who are been in Malaysia long enough during the time when Putrajaya was first, it was called MSC. So now it's called MD status. Essentially, I think most of the data center operators in Malaysia, if you look at the list on MDEC's website, nearly all of them are actually MD status. And the benefit is that there is you get a benefit of about 10 what they call bill of guarantees. I won't go through all of them. For example, BOG 5 talks about tax incentives, right? But I think the important ones from my perspective as a lawyer is BOG3 and BOG4. So BOG3 talks about freedom of ownership. So just now I talked about the MOE equity condition, right? If you come within the EPU guidelines. Now, the EPU guidelines has an express exemption that if you are MD status and you're located in an MSC area, then it is exempted. But it is silent on the situation where you are not located in an MSC area. So under what we understand from the MOE is that if you are an MD status company, generally they will consider to waive the equity condition. I mean, it's something to be discussed with MOE, but there are certain conditions that come along with that. But essentially, you have a chance of getting the equity condition waived, even though you don't come within the express exemption in the EPU guidelines. Now, the second one is for MCMC. So if you need an NSP or NFP license that I mentioned earlier, and if you are MD status, that I understand also that there is a possibility of submitting to MDEC for exemption. So these are things which can be explored if you are an MD status company. And the final one is BOG 4, which is the freedom to source capital globally. And this is pretty, to me, it's pretty amazing as a finance lawyer, because a lot of my time for the last few years have been spent trying to structure foreign currency borrowings to not require Bank Negara approval, including granting of security. And now there is a pretty clear mechanism, right, between the MDEC and Bank Negara, where a general permission letter is issued by BNM to an MD status company. And that essentially allows the company to borrow in any amount from non-residents. It is typically up to 5 years. There are some conditions, which I won't really go through, but nothing really material or very difficult to comply. But essentially, it's a 5-year approval to borrow. So I think I'm very happy that the relevant government agencies are providing the various, I can't say incentives, flexibilities, right, to really spur the growth of data centers. And as a lawyer doing data center deals, I think it's very heartening, and that really helps financing, at least. I mean, talking about financing. So the Bank Negara GP letter is really a step in the right direction. Yeah, thank you.
Okay, thank you for that. We will move on to commercial considerations. Roy, over to you. So regardless of type of data center financing and the structure, key commercial concerns of lenders will remain largely and broadly the same. So Roy, could you please discuss with us in terms of analyzing, segregating, evaluating data center specific risk, how does Alliance Bank distinguish it against common infrastructure projects, other common infrastructure?
Yeah, I think in the previous panel, of course, Vishesh and Shireen have given their take on some of these as well. So I'll try to find ways to put in some additional stuff. Secondly, I think we also like to say that I think every FI has their own kind of way or strategy how they want to approach this type of financing. So obviously, what we can say here may not be specific, right? But as essentially the more common points when it comes to it. I think the first thing, obviously, which is obvious, is the operator developer risk. Now, in this instance, I think that one is quite obvious. They are the borrower. But probably one thing to look at would be pre-completion performance. So obviously, you're looking for someone who has some experience in this area. They kind of know what they're doing, right? Because at this point in time of the loan, the construction time, you kind of don't really have that source of income. Probably not that much recourse. So you're really looking at the ability for this particular party to perform and get that done in the shortest. Well, I mean, I think typically you're looking at 1 year. Some people tell me 6 months, but okay. I think when we speak, probably a 1 year to 1.5 maybe is a bit more reasonable. The other thing, of course, is their financial backing. Cash reserves, I think, is important because there could be instances of overrun. Essentially, you just want this party to be able to withstand at least short-term, so to speak, unexpected turn of events, right? I think once that is completed, you shift to the off-taker risk. So that probably just as much due diligence is needed in this area. For off-taker risk, I think obviously it's the contract that you look at, and usually these are the big names when you talk about hyperscalers. So usually their names would not be in doubt, as the demand for this area is rising. So I think we just want to ensure that the switching cost or the propensity to shift is really quite limited, right? So that you have that tenor of contract with off-taker. Maybe one thing I would add on would be things like land. I think you spoke about land, and really there also needs to be the perfection of charge for the land, because if let's say you're the commercial banker and you actually finance that asset, if you don't have the rights to the land, right, you actually will find it very difficult to even have any hold on the asset or take possession of it, even though on paper the assets may be charged to you. Perhaps the other thing would be regulatory risk, in the sense of what's happening within the country. Will there be, for example, any carbon tax, tariffs, right? These are all very dependent. I think there was a chart that says that there is enough water. Okay, that's very good. It's raining today, so plenty of water for the DCs to cool. Yeah, but regulatory wise, because in the first place, this whole boom started also because of a regulation in Singapore, right? So then what happens in another 3, 4, 5 years? These are some of the things that need to be taken into consideration. Sustainability, I think there's a question on that later, so I'll kind of hold off to that. Maybe these are the main ones. Technology risk, I think they have spoken about it. Officer listens, that one hard to predict, 5 years, what will happen. I think we were saying from the 100 and now 130 kilowatt per rack, right? What will it be in 3, 4 years' time? For now, yeah, before we move on.
Okay, I think the earlier panel briefly kind of like charted into this waters, but in terms of structural features, can you elaborate on the type of typical financial covenants and restrictions that we are likely to see in terms of, for example, gearing limits, coverage ratios, security, sponsor guarantees?
Okay. Well, I think maybe start off with a bit of structure. The previous panel also touched on this. Within that 1 to 5 or 1 to 10 year period, there are a lot of flexibility, right? It can be bullets, any number of years bullet. Maybe one way that we look at it would be perhaps the first couple of years bridging with moratorium for the bill. These are typically not easy to have a kind of a cash flow matching, right? Rental incomes are not existent then, right? So that bridging loan basically helps to move the whole project and build along with its own conditions within there. Debt to equity would be one, so there is also skin in the game. Perhaps anything range, again, flexible, case to case, right? Can be 60, 40, 30, 70. But I think you get the picture that the borrower himself has to be someone who can put up a significant amount. You're talking about, say, a 1 billion USD kind of financing, right? So this is not a small potatoes kind of game, right? Secondly, I think if we look at it, the other ratio would likely be a loan to cost ratio, right? So a loan to cost ratio to ensure that the borrower would, it cannot be keep overrunning the costs, right? So the borrower will need to cater for any overrun, for example, in the bill or the timeline, right? So this could be one of the other ratios. Again, when I say could be, is because these are not like every single contract is a template, just template. These are complex deals, so it's always negotiated, right? Another one that comes to mind would be things like negative pledge, right? So that you do not, you want to see a kind of a fiscal discipline in terms of the borrowing undertaken. as well as charging of certain assets. And we talked about cash reserves and of course, debt to service ratio. In the early days, probably it's more of interest service ratio, right? At least the ability to cover the interest portion. Because after you move on from the bridging loan, you probably have a takeout loan, where the takeout loan is that 5-year or 7-year, right? It can be amortized or bullet, right? And by that time, the rental incomes would have started to cover, and then you can have, of course, the escrow account that would hold the monies, right? Quote unquote cash trap. So you would extract the operating costs, the interest, and then the principal repayment, right?
Okay, we'll move on to Yijing. Yijing, we'll pick up from where Roy left off. Could you probably expand on how S&P's risk evaluation framework may differ from some of the risks that's already highlighted by Roy?
Okay, thank you. And thanks for the invitation to speak here as well. So other than what Roy has mentioned, I'll just touch on a few unique characteristics to data centers in how we look at them. So I think the good thing about being in the last panel is that in the previous panel, the moderator has already got a cheat sheet up there. So I won't go into the big features of hyperscale colo in wholesale. But the first thing I want to bring up would be for the length of contracts. So for hyperscale wholesale data centers, clearly they have a longer contract length, 5 to 15 years, as compared to retail colocation, typically much shorter contracts, 2 to 4 years in the ballpark of that. So as from a credit risk point of view, the longer your contracts, of course, the better your earnings predictability and better earnings stability. But that is not to say that for all retail colocation, it means that you have poor earnings predictability. What we then look at would be for a retail colocation, what is the level of interconnection? What is the level of cross connects? So to explain that a little bit, if a DC facility houses like a few connected network providers, these network providers being there would attract cloud providers to then want to collocate at the DC, and in turn attract enterprises to want to collocate there as well to form the direct secure connections with the cloud providers. So as you can see, there is this network effect that's being formed. And this network effect would mean that there'll be much stickier customer base. There'll be high switching costs for these customers as well. And therefore, we see that as a key competitive advantage for retail colo DC. The second point I want to bring up would be the tenant concentration risk. So as we talked about in the previous panel as well, there is more tenant concentration for hyperscale wholesale DC. And again, for a credit rating agency, the more tenant concentration you have, typically the higher risk there is. But again, you know, whether a high tenant concentration really weighs on a credit rating, like the economists earlier in the day, I would say it depends. And what does it depend on? It depends on the counterparty credit risk. So to that point, I think just like how we look at, for example, retail landlords, you won't look at the counterparty credit risk of all the retail tenants that you have. But the moment you have a very high concentration on it, then we'll dial out the emphasis on the counterparty credit risk for someone that you have very high exposure to. The third point that I want to talk about would be the cost structure of data centers. So for wholesale hyperscale data centers, they tend to be on triple net leases. And electricity costs, of course, is a very key cost component for data center operators. So in triple net leases, they're going to be passed on to the tenants. But where contracts, in contracts where electricity costs are borne by the DC operators, then we then look at whether there are other mitigating factors. So for example, are there price escalation clauses that could kick in within the contract if electricity prices reaches a certain level? Or there could be things like, is there a PPA on the back of that that can help to reduce the price volatility? So this will be the things we consider as well.
Okay. I think something that has been recurring and repeated many times is this potential tenure mismatch. So it's quite clear that the Malaysian bond market is actually quite spoiled in that whether it's the solar PPAs or power, coal, gas, our highway structures, our social infra, they tend to have concession agreements that stretch 21, 25 years, even up to 50 years for highways. So what comes up quite often is that a lot of the hyperscale contracts are longer, while the co-location ones may be shorter. So in that sense, that mismatch in terms of bringing this particular fundraising or funding of these assets into the bond market, any views on receptivity of our local investor base on rollover risks or refinancing risks? Roy, if you could help us with that.
Well, I think, okay, so for that part, I think if you look at the tenor, right? I think they're a bit different now, right? Co-location, I think the previous panel also said it's kind of like a mall, right? Like a REIT. You build it, and then you have a diverse tenant base. I think if your mall is good enough or your place is good enough, the kind of like people switching out of it is fairly low, and maybe you can easily get people in. Hyperscalers, on the other hand, is sometimes more bilateral, or maybe 1 to 2, right? Built to fit, right? So I think if we think about it, there may be two things. Number one, eventually in that scenario, you're going to hit some client limit, right? All banks, all FIs have this client limit per client, and it applies to the counterparty as well, right? So what happens then is eventually you have a ramp up, but after that you kind of plateau out where everyone says, well, I'm quite full already, right? I can't go for the buffet anymore. So I think at that point in time, and then that's when you probably still have balance within that loan, where you may want to now look at placing that out, right? So it achieves kind of like maybe it kills two birds with one stone, right? You can so-called replenish your appetite, I suppose, by having that risk participation out there in the market. And at the same time, I think you can structure it off, because once the completion is done, essentially by right, the switching should be quite, I would say it's not that simple to switch, right? And you've got a constant source of cash flow from essentially a very strong paymaster, right? So kind of like quite perfect storm, right? To create a very desirable product in the market.
Okay. S&P recently issued their rating approach in terms of how they would rate data centers if they were to be funded via the bond market. They came up with 4 approaches. Yijing, if you can walk us through briefly. And as hyperscale funding is fairly new in Malaysia, if you can also give us some context whether there's a preferred rating approach in terms of how you would fund a hyperscale data center.
Yeah, so preferred approach, again, I'm a rating agency rep, so we don't talk about structuring here, so I can't really answer the question. But if we talk about the products there are out in the market, I think firstly it would be to understand the contextual backdrop of DC financing right now. So of course, DC we know is in a growth phase, and that's why we're here talking about it. And therefore, the speed to obtain financing or the lead time that's required before a financing can be done would be something that is key to a data center operator. And if I were to go into the types of products I'll segregate it into 3 main buckets. So the first one would be structured finance, the second being project finance, and the third being corporate finance. I'll delve into a little bit of the reasons why some of these products may be chosen. So the first being structured finance. When we think about structured products, they can really only take place usually in economies where legal conditions are supportive. That means in emerging markets, it may take time before such structures are feasible. And these comments would then come from, looking to more mature DC financing markets, which is in the US, to offer some clues about what could happen in this region. So for ABS, the benefit that it brings to DC operators is that it is a very scalable long-term financing option through a master trust setup. So what this means is that there will be a issuer, the SPV issuer can essentially issue a series of notes over time, with each of them participating or sharing in a collateral pool. And after a master trust is set up, then subsequent issuances will just require quite limited documentation and therefore would be quite straightforward. So if we think about the speed to financing, that could be a plus. I think the other thing I'd like to share is that in the US, what has been seen is that ABS can be a cost-effective financing option as well, as compared to issuance out of a corporate structure. And that's because in structured finance deals, right, operators can essentially kind of cherry pick assets and put them into structures. And therefore, the credit rating of these structured finance structures can sometimes have higher credit ratings than if it was out of a corporate issuance. So there is that benefit as well. So moving on to project finance, this is typically when there is unmitigated construction risk and it's in a ring-fence structure. So it could be a case where, you know, if a project finance for DC is undertaken by a corporate entity, then it could weigh on the entity's balance sheet and the rest of its operations. Whereas if it's in a ring-fence structure, then of course the project assets and the associated future cash flows coming from the project will be what form the basis of this financing. So the downside of it, however, is that project finance is project specific, which means that you know, the time to market, the time to obtain financing could be slightly disadvantageous. And of course, corporate finance is easy. It would be usually the case when you have a pool of already operational data centers. So the natural question, how S&P approaches rating data centers with different financing vehicles. The financing vehicle, very simplistically, informs our choice. So if it is an operator of a DC that issues the bond, then it will be under our corporate methodology. If it is SPV that has unmitigated construction risk, exposure to operational risk, then it will be project finance methodology. And finally, if it is, you know, in a structure where it's structured finance, depending on whether you have ownership over the commercial mortgages, it might be CMBS. And then if you have direct ownership of the data center assets, then it will be ABS.
Okay, I hope that was not too much of a mouthful, but all right. Now we will move on back to Kelvin. If you could please share some benefits of issuing bonds. I think the work you've been doing in the last 1-2 years has been dominated by loan market. Is there any way that means in terms of bringing bond financing? And if you could also cover a little bit, why is it important that investors have the bond and capital market on their radar as well?
Yeah, thank you. So as shared by the previous session panelists as well, we are seeing pretty much 100% loan and PE funding, right, for data centers currently, at least in Malaysia. Maybe in US, ABS and bonds are more popular. So I guess what does it take for us to see the first data center here being maybe refi using a bond? Now, the benefits of a bond program or Sukuk program in Malaysia, and I think in Malaysia, we have to be aware that we are one of the biggest Sukuk market in the world, right? We have huge liquidity for ringgit Sukuk. So the first benefit is it's a program. So in other words, if you do a loan and you refi, every time you refi, it is a fresh loan, right? And you pay stamp duty, fresh documentation, new banks come in, etc. Whereas for a bond program, the structure that the trust deed program agreement stays the same. Your investors may change, right? And the terms specific to the issuance can change. The issue specific documentation, not too complicated, right? So that's the first thing. And because of a program, we have the issue of a tenor of the customer agreement. In theory, of course, subject to the bankers here, we can always structure shorter term tenors, right? Once the project is making money, it's cash flow accretive, you can actually issue a bond with a tenor that matches or slightly shorter than the customer agreement. So that's that bit about the program and the benefits compared to a loan. The other big point is actually stamp duty. So you may be aware that early this year, for foreign currency loans, it used to be a 2,000 ringgit cap on stamp duty. So that has been removed in the amendments to the STEM Act. So I think bankers and data center operators, we are finding ways to try to structure the deal to not pay the ad valorem stamp duty, which is 0.5% of the total amount of the loan. If you're looking at DC's 1 billion ringgit funding is a lot of money, right? So if you do a bond or sukuk deal under the SC's the exemption order, it's actually waived, right? So that's the first thing. So you get a stamp duty complete waiver. Of course, you need to go through the usual SC process, right? But the main thing is you get a waiver from that. And the other incentives, if you do a sukuk, there is still an exemption order. I think it's an income tax order where if you do a wakalah deal, you still obtain tax deductibility on your issuance expenses, right? I think that's still available for wakalah if I'm not wrong. And moving up further, if you have a green data center, Waiman talked about YTLs having the first green data center funded fully from renewable energy. If you can fit within the SC's SRI Sukuk framework or the ASEAN Green Bonds framework, then you may be able to come within additional incentives under the SC's SRI Sukuk grant scheme, etc. And I think under the current LOLA guidelines, you have energy efficiency as one category, you have green buildings as one category, and the idea is whether your DC can fit within that. I understand that I think the MCMC has issued a voluntary code on basic green data centers, so that can serve as a benchmark as to how to fit your DC within the green data center framework. So with that, you can actually get additional incentives. So I think the idea here is that, as you know, Malaysia is very strong in solar sukuk financing over the last 7-8 years. It's a tried and tested product. The main difference is that there is always a maybe 25-year solar PPA. Whereas for a DC, you have maybe a 10 to 15-year customer agreement. So I suppose it's how do you fit it in? I think it's just a matter of time when most of these bridging loans for DCs mature and you need to refi the balloon. I think it's something that is doable, at least from the legal perspective. But again, we need to ensure the investors are satisfied.
Okay. I will move into the last question. Kelvin, if you just want to take us through in terms of loan documentation, security arrangements, any specific structural features or nuances that lenders need to be aware of? Because it also kind of gels nicely with the second question. So we have a question here. What are the other ways to fund the development of DCs other than conventional bank financing, especially when there's restrictive covenants from the DC end users on the encumbrance?
So I think I talk about two things. One would be, yeah, I'll just cover 2 points, maybe in just maybe 3-4 minutes. First is on a new structure that we are seeing in some deals using the Labuan SPV. That's the first thing. And I think specifically on the question on restrictive covenants for DC end users, I'll explain a little bit about this document called the SNDA, the Subordination, Non-Disturbance and Adjournment Agreement, right? So the first thing about the Labuan structure is this, related to the stamp duty point that I mentioned earlier, the removal of the cap. That there is an existing exemption order where if the Labuan company is the party to the agreement, for example, the borrower, then, and you comply with certain substance requirements, then there would be full exemption on stamp duty. And this also affects, or this also applies to the security documents in connection with that loan. So we are exploring, I think, certain deals where we are using a Labuan SPV to be the borrower from offshore lenders, and then on lending the proceeds to the Malaysian DC operator. So substance requirements, for those who are not so familiar, would include things like having a physical premise in Labuan. You need an office, a tenancy agreement. You need to have staff, at least I think 1 or 2 workers full-time in Labuan. So that's the first point, something that I think it's not really completed, but it's a structure which we are seeing. Now, the SNDA actually stems back to the co-location agreement or hyperscale agreement. So as you know, there are 2 big elements in any customer agreement. The first is the right to use. The second will be the services. So the right to use, the extent of which will depend on whether it's a colo or hyperscale. So if it's a hyperscale, you're probably renting the entire building. If it's a colo, it could be just a shelf in the building, right? And the second link is the services, the extent of which the DC operator or the owner is able to provide services related to the data center. And the extent of which you provide services would then attract certain licenses under the MCMC, as I mentioned earlier. If you are, for example, a network service provider, network facilities provider, right? And it will also affect the stamping of the service agreement, which is a very complicated point because within this customer agreement, you have elements of services, you have elements of lease or tenancy. So this is something that you have to be mindful when you draft the co-location. So very quickly on the SNDA, SNDA essentially has two big elements. It is essentially something, a document required by the customer if the data center operator wants to obtain financing from a lender and that financier wants to take security over assets which affect the data center, the customer's rights. So example, a land charge, a debenture, or assignment of the customer agreement. So all these securities would in some way or may affect the interest of the customer. So it is pretty market practice that as part of the customer agreement, the customer will insist that the DC operator gets the lender to sign this tripartite agreement between the customer, DC operator, and the lender. So we call that the SNDA. And in very simple terms, there are two types of provisions in the agreement. The first one would be for the benefit of the lender. The other one will be for benefit of the customer, right? So for the customer side, essentially they want non-disturbance. So they want the lender to recognize the customer's interest and ability to use the data center. And they want the lender to say that if there's any enforcement, they will try their best not to affect the customer's use of the premises. It even goes on further to say for enforcement, sometimes you have a notice in advance to be given, right? From the lender side, obviously we want the customer to agree to the assignment, acknowledge the assignment to the lender. Also, if the customer wants to terminate the customer agreement, sometimes there is some arrangement of advance notice being given to the lender. No, sorry, yeah, the lender. And finally, this concept of attornment. Attornment actually means if the lender wants to sell the step-in rights, right? Step in and sell the project to a new DC operator. What are the parameters? So sometimes we pre-agree on certain qualified DC operators who can come in and take over the project via innovation. So, and we get a customer to pre-agree to certain parameters. So essentially two main points are clauses which are customer friendly and clauses which are lender friendly. We negotiate on that and hopefully come to some landing. And this is normally signed at the same time the security documents are signed. Yeah, I think I'll thank you.
Okay, we can go back to the Q&A. We apologize. We will henceforth not be able to take any banker questions. Okay. Yeah, so the first one, I think maybe very related to Roy, but would you like to attempt it? So how do banks, so let's just say, how do credit rating agencies rate and assess DC operator profiles, and if country of origin is key in the assessment?
Yeah, so I guess the points that, I brought up earlier was more on the competitive position, earnings qualities of DC operators. But of course, there are other aspects as well, and one of that is country risk. So I wouldn't really say the country of origin is key. What we look at would be the country exposure in terms of revenue, EBITDA, or where your assets are. So indeed, if the country risk is higher, then that would weigh on the credit assessment.
Okay, so there are some country caps and sovereign caps that may apply.
That is right.
Okay. All right. There is increasing geopolitical interference around data flow and storage. How do we quantify the risks when it comes to data center tenants and hyperscalers? I take it this a little bit into the data sovereignty discussion earlier as well. Anyone willing to take it on? How do we quantify the risks when it comes to tenants, hyperscalers in terms of geopolitical interference around data flows and storage? No? Any takers?
I'll just attempt this question. So I think the trend now is you have data center players from maybe Singapore, other countries coming into Malaysia, setting up data centers, and the issue then is the data which are owned by maybe non-Malaysian companies being kept in Malaysia, and you have personal data protection laws, right, in Malaysia and Singapore. So I think this is an issue which is a G2G point, whether there'll be exemptions or how would each country manage the storage and access to another country's data, and how would the relevant countries' personal data protection laws come into play, and because there is inevitably an overlap, right? And there are risks involved, obviously. So I don't think it's something that has been clearly discussed or resolved. So we hope that between Singapore and Malaysia, at least we are I think the closest, something can be addressed in the near future.
Yijing, do you want to weigh in if it features heavily in your analysis in terms of data center rating?
Yeah, I'll say where it features most heavily. I mean, what I can think of right now would be if the tenant is something that is government related, then that could be when data sovereignty issues could be higher, and therefore, renewal risk of such government related tenants could be a risk to DC operators, I think.
Okay, we'll take one final question and then we'll call it a wrap. We see rising record prices being paid for acquisitions of land for DC in Johor lately. What are your views as a funder? Any views? I think our banker has left. We apologize. Okay.
All I can say that's correct. I've seen a case where at the very last minute, the price of the land, or rather the seller increased the price of the land at the last minute due to high demand. Yeah, I think that's all I can say.
In terms of, I think this one maybe refers to a moratorium. Is there any rule requirement that data center location lock in for some period?
Not that I'm aware. I don't think that.
Okay, we've managed to cover all the questions. With that, we thank you. Now we've come to the end of the forum. I hope it has been a good one.
Right, once again, we would like to thank our esteemed panelists, Yijing Ng, Roy Hyong, which have to leave because of his flight, Kevin Low, and of course, thank you to David Duckoff for moderating the discussion. And we'd like to invite our moderator and panelists up front for a photo opportunity. Well, ladies and gentlemen, that concludes today's conference. We hope you leave with valuable insight and connection. Thank you to all our speakers, sponsors, delegates, guests, and the many RAM friends and supporters for making this event a success. Ladies and gentlemen, have a safe journey home, and we look forward to seeing you in our next event. So till next time, people, have a pleasant evening. Bye-bye, and we'll see you.